So let's get started here. So today we're going to be talking about allocating your cryptocurrency portfolio. So how can you optimize the way you allocate your capital in your portfolio to maximize your returns? And so we want to help you achieve the profit that you're trying to achieve and that you really deserve. And there's a ton of different ways that you can do that. Let's start off here with the agenda. So there's 5 different things that we're going to be talking about. First, we're going to start off with the 3 essential components of maximizing your portfolio's profit potential. From there, we'll move into the different routes to generating cryptocurrency returns. There are several. Then we'll go into the cryptocurrency asset types available to you. So there are also a ton of these as well. And I'll point you to a source that you can see all of the different asset types, because we won't have time to cover all of them because there's over like 40. And then we'll go into creating the optimal portfolio through different allocation percentages. And then finally, we'll finish off with some of the pro tips that I have for you guys for portfolio optimization. So first off, when we're thinking about allocating our portfolio, we need to realize that this is worth a lifetime of profit. If you guys can figure out how to optimize your portfolio and how to allocate capital correctly, you'll generate consistent returns for the rest of your life that'll just increase your quality of life. So there's really 3 things that we need to keep in mind to maximize returns here. So the first thing is choosing the right types of investments. So this is, before we choose the actual investment itself, we need to choose the type of investment that we're looking at entering into, and kind of we'll talk about that in the next slide, the way that you're investing into these different things. Second is choosing the investment themselves. So this has to do with, this is where you're choosing something specific, like I'm going to actually buy Bitcoin, or I'm going to actually buy Ethereum, or things like that. And then last but not least, we are talking about structuring your portfolio to allocate your capital in different percentages. So we'll talk about different strategies for that as well. So starting off here with routes to cryptocurrency profit, there are 6 of them that I want to talk about here today. So starting off here with lending. Lending is a very straightforward concept where you're taking a cryptocurrency that you own and you're lending it out to either a centralized or a decentralized lending platform. They loan that money out to another person on a loan, and they pay you interest for you providing the capital. So it can either be a short or a long-term investment strategy. And for each one of these, you can see I wrote in what type of investment, and time frame these are. So you can think about which ones, out of this list do you want to focus on, and then decide, which investments do you want to look for inside of these routes to cryptocurrency profit. You can generate a ton of different streams of income through these different methodologies. So the second one here is trading. And this one is where you're buying and selling cryptocurrencies on a short-term time frame to generate a profit. So this one's very straightforward, and we talk a lot about this at Lutheria because I myself am a cryptocurrency trader, and I'm profitable with that, and I share my trading ideas to help you guys learn how to do it as well. So this is an inherently short-term strategy because you're either buying the cryptocurrency and then selling it at a higher price to generate a profit, or shorting it where you're betting that the price is going to go down and then buying it lower and pocketing the difference between those 2 prices. So you don't really care too much when you're trading if the asset is something that you want to hold long-term, because you're just, in it for the short-term price movement based on your technical analysis. And then third, we have investing. And this is a very long-term approach. So this is where you have a large time allocation up front. You're spending a bunch of time, reading things, watching videos, talking to people in the space, and figuring out is this something worth putting my money into that I think in the future, this is where the future is going. I want to leave my money in this investment or this asset for a while, and then over time, eventually sell it, years down the line. So that's a long-term strategy, and something that I think, we all should consider allocating in our portfolio some percentage towards an investment. And then fourth, we have earning. So there's different ways you can earn cryptocurrency, but one of the 2 different ways, one of them is on Coinbase. You can go onto Coinbase and, basically complete these video quizzes for these different cryptocurrency projects, and they reward you in cryptocurrency for completing the quizzes. It's basically, they're rewarding you for your attention and learning about their project. So then you eventually hopefully become a user of their project. But you as a user can decide whether you do or don't, but you can earn cryptocurrency that way. And then you can either sell it for cash, or you can hold on to it and use it on their platform, or later on sell it for cash at a later date. So that's a short-term strategy. Another way to earn crypto is through digital fund management. So this is a new development in the cryptocurrency space where you can think of like hedge funds. The way that that works is as an investor, you're allocating some of your capital towards the hedge fund. They're investing the actual capital into different investment vehicles and then providing you a return if those investments end up becoming profitable. But you have to be an accredited investor for that. Usually it means you have to have a lot of money to even get into those types of investment opportunities. So in blockchain, it's different. There's actually platforms like Enzyme and others that are allowing you to allocate your capital towards digital fund managers using things like smart contracts that allow you to earn a return on someone else's trading or investing performance. So they allocate your capital and earn a return, hopefully. And then if they do, they allocate a percentage of that profit to you, which is a passive way to earn crypto. And then fifth, we have staking. So staking is where you're taking some of your cryptocurrency that you own and you are staking it and saying, okay, I have skin in the game in this blockchain and I'm going to validate transactions on the network. And I hope to get rewarded by validating those transactions. So the network itself has to, this is a complex concept that I don't want to dive too deep into, but the way it works is in a simple form is you're staking some of your cryptocurrency in the network and you're saying, I will use my computer power to validate transactions. And you get rewarded by the network to validate those transactions because they need someone to do it. So they have to incentivize people by paying them in cryptocurrency. So you can stake, and that's a long-term investment because you're spending the time to decide, okay, which network do I want to stake my cryptocurrency in? Which network do I think is going to grow over time? So that's, once again, it's very similar to investing where you're doing a bunch of work up front. And that's the consistent trend across all long-term opportunities is you're doing a bunch of work up front to then not have to do too much work down the line. Like once your computer is set up for staking, you just generate returns and you just validate transactions. There's not a lot of upkeep for that. And then we have mining. So mining is another long-term strategy. And this is where you are going to be solving a mathematical problem. And if you solve that problem correctly on a blockchain like Bitcoin's, for instance, you get rewarded Bitcoin. And so you're basically adding transactions to the blockchain by solving this problem. And so you're adding blocks to the chain. And so it's called mining because you're basically creating new Bitcoin. And so that's another long-term, strategy because you have to invest in the hardware to, solve those mathematical problems. You have to spend the time to learn how to set everything up and, choose which cryptocurrency you're going to mine and things like that. So we want to keep these different routes to cryptocurrency profit in mind as we're thinking about creating our portfolio. Okay. And so you're going to choose some of these different routes. And then within these, you're going to choose some different asset types. So here are some of the different asset types that are available to you as an investor in the cryptocurrency space. These are only 4 of like 45 different categories in cryptocurrency. So there's like 45 different types of cryptocurrencies right now, according to CoinGecko.com, which I'll point you to that resource at the end, as well as some other additional resources that you can reference. And you can see all the different asset categories. But the first one here is Bitcoin. And this is basically acting as an investment into a store of value or a digital gold per se, or also something like, a hedge against bad monetary policy. So people in the US right now are worried that the value of the dollar is going to go down. And so because of that, they want to retain their wealth that they have now. They don't want to lose that when the dollar value goes down. So they're buying Bitcoin in hopes that Bitcoin's price will rise as the dollar value falls, causing their wealth to either increase or stay where it is. So they still have their purchasing power. And so that's kind of the idea behind Bitcoin is it's a store of value. It's not really what it was intended for initially, but that's what it's evolved into now. So that's an asset type you can invest in. There's also platform tokens. So you can think of these as like the infrastructure layer of blockchain. So these are blockchains themselves. So not the token, but the tokens are an investment into the blockchain. So Ethereum is the largest example of this. And this is a platform, you can think of it kind of like the internet, in that people can build applications on top of the internet, and then people use those applications and they get value out of them. On Ethereum, people can build decentralized applications, and then they're on top of the Ethereum blockchain. So the transactions are on top of the Ethereum blockchain. Now, what that means is the platform token, the thing you're actually going to invest in, is not the blockchain, but something like ETH. So that's the native cryptocurrency for the Ethereum blockchain. And the way that that's used on the blockchain is people that have applications on the blockchain have to use Ethereum to transact. To use their application, you have to transact with Ethereum. So you have to buy Ethereum to use these applications. So if basically the bet you're making with platform tokens is that more people are going to build applications on these platforms, and more people are going to use the applications. And so there's other competitors to Ethereum as well, like Solana, or the ticker is SOL, and then Polkadot, with the ticker is DOT. Another one is exchange tokens. So this is basically acting as an investment into a cryptocurrency exchange. So it's very simple. The cryptocurrency exchange is where people buy and sell crypto. When you're buying an exchange token, you're basically making a bet that the usage of this cryptocurrency exchange is going to increase over time. More people are going to use the exchange, more people are going to transact on it. And a token like BNB is the native crypto for the crypto exchange Binance. And each of these tokens has some sort of utility. So there has to be an incentive for people to buy these tokens. They can't just create a token and just say, yeah, it's going to be worth something. It has to do something. So when you hold BNB on Binance, if you have an exchange on there, if you hold BNB in your wallet, you get a 25% discount on fees when you trade on Binance. So that's why people will want to buy BNB, is because they want a discount on fees. So as more users enter the Binance ecosystem, they buy BNB, causing the value of BNB to rise over time. So that's a very robust investment, in my opinion. And then lastly, we have stable coins. And these are basically, you can think of these as digital dollars, because that's basically what they are. The reason it's called a stable coin is because its value remains stable through time. So it's pegged to the US dollar. So one USD coin, for instance, which is a cryptocurrency, is worth $1 US. So in real life, the people that are minting the cryptocurrency, the USD coin, they actually have in storage the US dollars to back the minting of the cryptocurrencies. So they're not just printing cryptocurrencies out of thin air, but they actually have real US dollars that they're just creating a digital version of. So they're very, it's a very strong mechanism, in my opinion. And there's a bunch of different ways that you can make money with stablecoins. So one way is lending, which we talked about, and kind of like savings. So you buy stable coins. You can think of this kind of like how you're saving your money in your bank account, but you're earning like a 0.5% yield, which after inflation, you're actually losing money. You can take the money that you have in your bank, you can convert it to a stable coin using a platform like Coinbase, and then transfer that to a lending platform and earn like 8 to 10% a year on that money. So instead of earning 0.5%, you earn 8 to 10% for basically doing nothing. And so it's really nice. Another use case for stablecoins is cash reserves. So as an investor and trader, or however you're using different routes that you're taking, when you're investing, you don't want to have to do several transactions to get your money all the way into actual US dollars. When you're in the cryptocurrency ecosystem, sometimes you want to go into cash, like you want to sell some of your Bitcoin, for instance, because you're taking profits, but you don't want to take those profits and transfer them into your bank account again, because then that takes a bunch of time, and then to get it back into Bitcoin again takes a long time. So you want to keep them in the cryptocurrency ecosystem. And how can you do that? Well, you just sell your Bitcoin for something like USD coin or USDT, and there you go. You're in digital cash, essentially. So it's just like you're in cash. And then lastly, we talked about fund management. That's another way you could use stablecoins to generate a return. So this is just a statement that I modified from a statement that I heard, which was that perspective is worth 80 IQ points, I change it to portfolio diversification is worth 80 IQ points. Because diversification means you're spreading your assets across multiple, or your capital across multiple different types of assets. So in case, you have a simple example of this is if you held Bitcoin and you held USD coin. If the value Bitcoin goes down, the value of your USD coin did not change. So that's a diversified portfolio in a very simple sense, because you're maintaining a stable level of returns and of your money. Because as one asset goes down, you should try and create a portfolio that's diversified enough that the other assets either go up or they stay about the same, or they don't go down as much. Because then that way, if you have all of your assets in one bucket, if they go down, your whole portfolio goes down in value. And so the reason you diversify is because it's less risky and it helps you maintain a consistent return over time, which is what you want as an investor. So when you're thinking about crafting the right portfolio structure, now that we've talked about the different routes to cryptocurrency profit and the different asset types, so okay, I'm thinking about doing staking, investing, and trading. And I'm thinking about, you're going to then do some research on which asset types you want to go into. And then you're going to think about the allocation percentages. And this is the amount of the percentage of your money. If you have $1,000 in your portfolio that you're going to invest, you need to think about what percentage of that is going to go towards trading. What percentage of that is going to go towards lending? What percentage of that is going to go towards staking? And so then you start to think about risk. And so you need to think about which bucket your capital is going to go in. So there's two buckets. It's riskier investments and less risky investments for the sake of this conversation. And also, I just want to mention in this, I am not a financial advisor. So everything we're talking about is for educational purposes only. I don't want anyone to misconstrue it as financial advice, but this is something that is important to mention. But my personal strategy when I'm looking at making investments into cryptocurrency is I do a majority of my portfolio in riskier investments with potential for higher returns, and then a smaller portion of my portfolio into lower risk investments that yield lower returns. So I do, if you look at the example line here, I do 80%, 20%. So I do 80% riskier investments and 20% lower. Now, what does that look like in the routes to cryptocurrency profit? Well, I'm doing 20% of my portfolio into low risk lending and earning, and then 80% of my portfolio into trading and investing. And so then I decide which assets I want to invest in and trade in, and then which assets I want to earn in and lend in. So you can see how that works with all these different factors going in. And so the way you determine your portfolio allocation percentage is by using these three factors as guidelines. And so the first of which is your risk profile. So your risk profile is how much risk you're willing to take. So are you a risk-taking individual? If you are, then you are going to allocate a higher percentage of your portfolio towards riskier investments. If you're more risk averse and you don't like taking as much risk, you're going to allocate a lower percentage of your portfolio towards the riskier investments. You also want to keep in mind your time horizon. So this is how long you want to be investing for. Are you going to be an investor for the rest of your life, or are you trying to get rich quick? And I would say that the get rich quick scheme is not a good strategy. It's very risky and it's not sustainable. And so we'll talk about that in the next slide. But when you think about a long-term time horizon, you're going to have a preference towards taking on some risk. So the reason for that is because over time you're thinking long-term. So if you take some risk, it's okay if some of them don't pay off because you're playing the long game, and over time some of them will. And so the riskier investments give you higher returns once you're right, and it ends up paying off in the long run. If you're more of a short-term horizon, you're going to have a preference towards less risky investments. So these would be people near retirement. So they're forced to have a short-term time horizon because they're nearing retirement and they need that money to pay for things. And so they want to retain the money that they've made over the course of their investment career. And that's why I say take your age into consideration here, because if you are younger, the general consensus among investment professionals is to have a higher risk appetite. So you want to invest in 70% plus into riskier assets than than low risk assets. And the reason for that is because if you invest in all low risk assets, you're not going to make almost any money, and you're not going to have much money to retire with. And if you end up losing a little bit of money along the way because you make mistakes because you're young and you're learning, it's okay, because over time you understand the fact that investments in aggregate go up over time. The market as a whole goes up over time. Things, when you think about the cost of things, a very important point to make. When you think about the cost of things, they might short term go down. Like the cost of gas might go down a little bit over the course of like a year or two, but it's never going to permanently go down. It's always going to continue to rise. And I mean, like something like gas, like a fossil fuel, who knows, with that, if like we renewable energy and everything. But like when you think about the markets as a whole, the stock market, the reason why it always goes up is because the price of things is always increasing. People are always raising prices. We as a species are always getting wealthier. So when you invest, you're going to make money as long as you're, betting on like the whole. As long as you're betting on the whole market and you have a diversified portfolio, you should generate some returns. So that's why when you're younger, it's better to have a higher risk appetite, because you'll get higher returns over time, or you should. And then lastly is your goals. So your goals, you think about like retirement, you want a certain amount of money to retire with when your career is over. Maybe you want to retire earlier, so you need to factor that into your portfolio allocation. And then also self-sovereignty. So with Lutheria, we're trying to help our community members become self-sovereign. And what does that mean? Well, that means taking control of your future and being able to have more experiences offline that are fulfilling, that having the experiences that you want to have and not be stuck in a 9-to-5 job at the office all day long, every day of the week. We can make money online using cryptocurrency and blockchain instruments, and we can become digitally self-sovereign, and we can control our money, our finances, our futures. And that's really important. So if you have those goals in mind, you have to keep those goals in mind when you're thinking about allocating my money. How can I build the skill sets? When we talk about like these trading skill sets, investing skill sets, lending, you don't need a skill set. Like earning, you don't need a skill set either. That's why it's a low risk thing, because you just put your money in and you just wait for a return. But like staking and mining, I don't know how much, skill goes into that as well. I mean, you have to know how to set it up, but like trading and investing, there's a skill there. And so how do you cultivate those skills so then you achieve these long-term goals? You have to keep that stuff in mind. And this parlays perfectly into our pro tips here for portfolio optimization. So the first of which is take a long-term perspective. Don't try and get rich quick. Don't try and be a hero. What you want to do is you want to take a long-term approach and say, I'm okay with starting off small. I have a small portfolio. Everyone starts with a small portfolio. Most people, unless you were born rich, you're going to start with a small portfolio just like everyone else. But once you make money, the rest of your life is so easy, because making money, once you have money, it breeds more money. Generating a 10% return on $1 million is 100K. So if you get to $1 million, you could essentially put that into a lending platform that earns you 10% a year, and you could live off of the 100 grand that you would make passively every year for the rest of your life. And so like, that's why you want to take a long-term perspective. And I know it sucks when you start off. It sucked for me too. When you start off small and you don't have much money, it feels like you're not making much progress. But every iteration, every skill you learn, every little piece of information that you retain is important. And when you're thinking about like attending events like this is helping your future. This is setting you up for success. And so you're doing the right things. So take a long-term perspective when you're thinking about building your portfolio out. The second thing is optimize around your strengths. So this is where, we go back to the roots to cryptocurrency profit. So if you're thinking about, okay, I want to trade, invest, earn, and mine. Okay, so, when you're thinking about how much am I going to allocate towards different, routes to cryptocurrency profit, you're going to think about where your skills at. For me, I'm a good trader. I'm good at technical analysis. So I allocate like 40% of my portfolio towards just trading funds, the funds that I use on a daily basis to trade, because I know that that's a low risk option for me personally, because I know how to do it successfully on a regular basis. So maybe you're more of a person that's like, I'm more of an investor rather than a technical trader. So I'm better at doing research and finding good opportunities and picking them. So then you optimize more, you allocate more of your portfolio towards investing. So that's how that idea works. And then the third pro tip here is design around your desired time allocation and activity level. This goes back to the same exact thing again. You need to think about how much time you're spending on these things, how much time you have available to spend on these things, and pick the options that are going to give you the best returns for your schedule. Like how much time do you have to allocate towards these things? And pick the option that's going to make you the most money, because that's what you're here to do. Fourth, think about not having a static allocation percentage. So don't think about, once you've made the decision, like once you go through these slides and you allocate your portfolio after you do research and stuff, don't just think the job is done, because it's not done. What you need to do then is, as the cryptocurrency market changes, which it always does, because it's an innovative space and there's tons of innovation happening. Like DeFi, for instance, is a new development that happened only a couple of years ago. And this development, you wouldn't have had a portfolio allocation towards that 3 years ago because it wasn't a thing. But now it is a thing, and a lot of people allocate money towards it. So maybe you should allocate a percentage towards that. So that's how you change things over time as you learn and you get new information. That makes you smart. When you get new information and you change your ideas based on new information, that makes you very smart. So consider that point as well. And then lastly here, consider conducting fundamental analysis. And we actually have an event coming up on doing that for cryptocurrencies, which is a unique thing because it's not like traditional finance, coming up in a couple of weeks here. If you guys are interested, you could sign up for that on lutheria.com, and then talking to smart people so you can pick the best token in a category and invest in just that one. So you want to avoid the spray and pray approach of, I'm going to buy, 5 cryptocurrencies in the DeFi space in hopes that one of them is going to, be the one that wins. You want to take the VC approach where a VC is not going to approach 3, social media companies and invest in all 3 of them. They're going to invest in one that they really believe in. And then if that one pays off, they make a ton of money. If it doesn't, they lose money. Yeah, but that's why you do your research. You ask people, you talk to people, you join the Lutheria community, you talk to us, and you learn, what is the best one in each category, and then pick that one and put your chips there, because then you can allocate more money towards one investment versus a smaller amount towards several investments. All right. So I hope you guys enjoyed the presentation. The last thing I have here is a couple helpful resources for you guys that I think you guys will enjoy. The first one is our Telegram community. If you're not part of this already, it's a free Telegram community that we have for our community where we post a ton of educational content around blockchain and cryptocurrencies. You can follow along with different trades and investments that I'm making. Ask questions, read up on some of the news articles we post. We talk about different projects we're interested in. So that's free, and you can join that through the link there. Another free option as well is subscribing to our monthly newsletter. So in this monthly newsletter, we share all of the updates on everything Lutheria for the month. It's a very short newsletter. And basically, we also share all of the different podcasts, blogs, books, and videos that we personally, as the team at Lutheria, found really valuable for that month. And we share that with you guys, and then also any other interesting projects that we're looking to make an investment in as well. So you can subscribe to that using that link. Third, you can sign up to trial our automated trading and investing software. So if you're thinking about trading and investing in cryptocurrency, one of the ways that you can simplify that process and save yourself time and become self-sovereign is automating that process. And you can do that with our software that's going to be released relatively soon, which allows you to create your trading and investing strategy, test it using historical data without using any of your real money. It's risk-free. You can see how much you'll potentially earn based on your return on investment using the back testing feature. And then you'll be able to automatically, the bot will monitor the cryptocurrencies you tell it to, and the bot will then generate automatic signals for you for when to buy and sell to generate profits. So then all you do is you log on to the exchange. They have mobile apps, so you can just do it right from your phone when you get a notification. And you buy it when it tells you to buy, and then you sell it when it tells you to sell, and you make a profit. I'm personally going to use that a ton because it's going to save me a bunch of time from doing technical analysis and a bunch of stuff like that. And the last resource here that I have for you is the CoinGecko crypto asset categories resource that I talked about, which is basically giving you an overview of all of the different categories that exist. The different, we talked about them as cryptocurrency asset types, but they list them as categories. You can check them out there. I also recommend you bookmarked CoinGecko because it's a great resource just overall for doing research in the cryptocurrency and blockchain space.